Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, September 21st, 2020. It is 10:31 Eastern Time as I'm starting the video. We'll take a quick look at the broad markets, and then I also want to speak to some of the other sectors and everything out there. And in particular, I just want to point out we have what I suspected we would once Qs broke the support and began the next leg down, and that is a broad-based sell-off. And a broad-based sell-off, just about everything gets sold. There were some recent changes in the, at least with one big broker, Interactive Brokers, a few weeks back when the whole volatility bubble started. Low volatility bubble burst. We started to get the sell-off down here. I know at least that broker, which tends to cater to more active and professional traders, they sent out notices saying they were going to reduce margin requirements. So, and what happens is selling then begets more selling. People have been loaded up on Tesla and Apple and all that on margin. You always, at almost actually at any point in time, there are more longs in the market than there are shorts. So when margin interest is very high, especially after a very long uptrend, it shows you people become complacent, thinking that the stock market's just an ATM that continually prints money and goes up. So if you've got 100,000 invest, why not leverage up and buy $400,000 of stocks? Your broker will let you do that. That's margin, where you can they basically lend you money to buy more stocks. And then what happens, it cuts the other way. Think about it. If you have a $400,000 portfolio with 100,000 equity in it, cash, your money, and then things drop, let's say like Apple, 20% drop, on 400,000, there's an $80,000 loss right away. So what happens then is you get the forced margin calls. So either way, I think that's going on, and I think that's going to continue to play out. And like I said, I think the drop this week will be relatively swift. We had that couple weeks of consolidation holding above support. This is a daily chart. The one I've been focused on the most is the 60-minute chart. And again, I did an update this morning with the charts on QQQ and NQ. There's the recent trading range boxed in right here. Futures started sliding last night into the morning, and that clearly took us down below there. So the sell signal is it's as good as it can get right now for the next objective short entry sell signal in the markets, with the breakdown, obviously this morning, especially on the little snapback rally after the open. I'll point out there's still the divergences, but the fact that so far we had divergences here carried us for a little rally. We put in another divergent low, another small rally. They're still intact. But at this point, again, I think I made it clear, I still favor, as I did once this went, we're going to continue lower and quite likely take out the divergences altogether. And if we do, that's going to be very bearish. Now, look, T5 was, and has been, my next target for a while. And now we may get there, and if we do, I think it's going to be relatively swift. I think this is kind of a point of recognition or a wake-up call, for all those that were buying, saw the QQQ holding support as the glass half full, meaning optimists saying, oh, well, the bears, the sellers can't take the Qs down below 268, and now they have. So you get that kind of mental capitulation. You also have, like I said, probably a lot of stops there. The day is young. We'll see what happens. There are still divergences on the QQQ 60-minute chart here. You can see. So if somehow, whether someone wants to say the Fed did it or just natural buying forces, it doesn't really matter. The Fed's a buyer that's buying forces. So if it's a Fed that comes in and guns the market, but they're typically supporting the they're indirectly supporting the stock market more so than anything. So take it for what it's worth is what I'm trying to say. If we get a reversal, here's a little wedge type pattern that I've drawn out here. We still have the bullish divergence. In other words, they're not taken out yet. If and when they're taken out, meaning we cross below those previous reaction lows in the RSI and the PPO down here, that's going to be very bearish. That'll be the first time in a long time. I mean, we had I think the last time we had positive divergence, I was pointing out on the 60-minute chart of QQQ, was heading into the March lows. And at that point, we had to come off a very healthy correction, and so the odds for a trend reversal and a meaningful bounce were likely. That's what I was stating at the time. This time around, we're coming off this 60-minute divergent low right off a much bigger divergent high on the 60-minute chart, daily charts, everything else. So I still favor these being taken out. So that's that. But the most important thing to watch today is if somehow, and I don't think it'll happen, but if anything's possible, if the market can pull a rabbit out of its hat and get back up there well above that trading range, well above 268, 270, especially on a closing basis. And then you're watching the same levels. We have a gap right there, resistance around 275, so forth and so on. But as of now, I'll make it very clear, this is as good a sell signal as we've seen now for weeks. That should open the door for at least a move down to T5. If we get any more selling, this is just my daily chart marking some levels, potential targets. 251 and a quarter-ish, we'll call it 251, and then 242. I'll turn this line on now if things happen to get real ugly. And I need to say this too because I may not be around for the rest of the day. If I have some contractors doing work on the house upstairs where they the internet comes in, and they're going to have to get in there, and I'm going to have to be without internet for probably the rest of the day when they get to that part soon. So I wanted to get the video out to you guys, tell you that as of now, check on the sell signals. It looks as good as it gets. Usually, not always, but usually if that was gonna prove to be a whipsaw, and by that I'm referring again to the breakout this morning, usually you're going to see the buyer step in right at the opening bell and then get us back above there. But the fact we've been trading now for what is it, 10:30 for over an hour? Yeah, probably not going to happen. Is what it looks like on the 1 minute chart. We gapped down, the buyers did step in, they tried to recover the losses, couldn't do it, and another leg down. So that's it, guys. Looks like we're going lower. That's the sell signals we were waiting for. And let's look at NQ, and same thing. I'm not going to spend a lot of time on these charts. Covered them quite a bit recently. There was our primary uptrend line. This was the near-term uptrend line. That was our golden, sell signal right there. Short entry pointed back then. Just a leg down. Reaction on the primary trend line. Breakdown back test. Traded in that sideways range for the last couple of weeks. Still have the divergences, but the story is they keep going, the divergence lines I have to keep dragging lower and lower. The fact that they're not playing out so far is certainly bearish, but they're not over yet. They're not burned out. So I think they will be taken out, but again, look at price levels. And again, that was really, really good support there. Numerous attempts or successful attempts at that level, and now we broke down. And here you can see, I'm going to zoom in here, you can see the futures broke down and back tested that level. So if you're we're actively trading this morning or last night watching futures, here you go, you had the breakdown, boom, you had a kickback to support. Once broken becomes resistance. So there was another nice shorting op this morning, and here we go, moving lower. So down we go from here, I believe. And again, my coverage on SPY and even IWM has been light, small caps, the other large caps, only because this market's all about the Qs. It was a bloated, overloved, overowned trade, and just as those stocks, as I pointed out for many months, were almost single-handedly doing all the heavy lifting, particularly the tech sector, not just the big fangs, but again, you have to look at the impact that Amazon, Apple, and Microsoft, just those three alone, have on the entire market because of their weighting. So, but yes, Tesla and all that was ripping, and Netflix, but their market cap isn't even close to that. So and point is, just as the big fangs lifted the market, they're going to drag it down on the way down. Somebody asked me I just replied to a question, it might have been from over the weekend, about XLV, the healthcare stocks. And let me point out here, down here in the bottom, you can see, oh no, if I do that, it's going to snap. Oh, okay, I'll snap the full screen. These are the 11 sectors in the S&P 500 right here. And as you can see, this is a percent change. They're all red, and they're all clearly red. So again, this is a broad-based sell-off. XLV, I said, look, I'll show you that chart just to kind of illustrate, what's going on, and it has corrected down to support. But you can see all these sectors down, financials down big again today. Point out some red flags there recently. But XLV, just for example, normally you might say, that this is an objective long entry, and I actually said that in the reply because I have a downtrend line right here that was taken out. We broke out that purple downtrend line. I colored over it in blue there. Here was our breakout right there, right? We broke out, and now we're back testing it, and price support. You can see that this is really where the healthcare stocks have been capping out. But what had happened recently is we had a uptrend line right there, very clean, well-defined. The uptrend line formed this bearish rising wedge, negative divergence. We broke down, back tested, and we've had, one, two, three, three waves down so far after the back test. We're at support. And look, we'll probably get a bounce here. We may, but it's just not my type of long. With the broad-based sell-off going on right now, everything's likely to get dragged down with the, especially if tech or the Qs cannot turn around and have that stick save where we get back up within the trading range. So that's why we're normally, I might say, hey, I'll take a shot here at XLV, diversify. It's pulled back to sports, had a decent correction. If we get more downside and we continue to see selling in the tech stocks, probably going to drag the market down, force margin calls, everything else. And XLV may come all the way down here at about 96.71. If you are bullish and you think we're going to new highs soon and the market and the correction's over or close to being over, then again, I've just pointed out, there's a support zone plus the trend line right there. You could go long with a stop somewhat below, or if we continue lower, add there. But anything much below that 96.71 is not good for the healthcare stocks. But anyways, and back to the whole broad-based sell-off thing. I'm not going to go through all my commodities, coal stocks, but they're all down. And again, that's part of a broad-based sell-off. I don't have a lot of green on my screen right now. I'm looking at sectors, commodities, even gold. Gold and the precious metals. Like I said, that's you can see gold has just been kind of flat and whippy lately. Remember, it ran into long-term resistance back here. Now it's been a couple months. It's been over a month and a half. And it's been a little whippy lately, whipped through this trend line, broke down, back tested, and now rolling over, and now it's taken out that 1911 support right there. So that's bearish for gold, near-term bearish. And again, part of a broad-based rally. You might be thinking, wow, stock market's down. Why isn't gold rallying? It isn't a flight to safety instrument. Well, typically it is, but there are other factors in play. Like I said, forced selling and things like that. Silver, same thing. Silver, I've been pointing out, we've been bouncing around in this range. I've been talking about here for weeks now, about 26,220 up to about 27,308. A few little failed attempts to pop above the top, and when it went, it didn't just go and we didn't limp on down. Look, it's big drop, 10% silver today. So that's quite bearish. You have trend line support coming in here soon. And price support. So I can say this right now, I wouldn't be shorting silver here. If anything, I'd be covering or going long because you're at price support and then trendline support just below for a bounce. But a big factor too has been the dollar, the US dollar. That has an impact on gold. I'm going to try to find dollar futures. Make sure this is up to date here. And that's it. Bigger picture, we had this downtrend line right here, formed a big bullish falling wedge as I'm drawing out there, positive divergence. We broke out right here. There was your breakout. Set up in this smaller 60-minute bearish rising wedge, broke down. My last update, we were here. I had this line. We're bouncing on this support range. And we're still, let me just erase all the lines and tell you what to watch for the dollar, because whether or not you trade dollar futures or euro or any Forex, this is likely to impact where gold goes. Remember, a rising dollar is bearish on gold. So see this big lift? We held that support that was highlighted last week and rallied impulsively off it to the top of the trading range. So this box right here, I think, is important on the dollar. Solid break above could open the door all the way up to that 95, 675-ish target, whereas a break below would be bullish for gold. Remember, rising dollar is bearish for gold. A falling dollar is net bullish for gold. When I say net bullish, doesn't guarantee every time the dollar's in a downtrend the gold's going up. All other things being equal, it will cause gold to go up. But if there's other forces, a lot of selling on gold for whatever reason, liquidations, margin calls, for example, or just market forces, that can sometimes this correlation between, or inverse correlation between the dollar and gold won't exist. But it certainly is worth watching. Okay, I had a brief interruption there. Back to the dollar. We were looking at dollar futures a second ago. This is UUP. Just want to rifle through these charts real quickly. Downtrend line there, and really a breakout right here above that recent consolidation. So this is UUP, the dollar ETN, also looking constructive. breakout today. So appears more upside in the dollar, which should put pressure on gold. You can also look at euro dollar pair, EUR USD. It shows the euro against the dollar. And remember, this is going to be bearish for gold when this falls. You can see the primary uptrend line right here was recently broken. There's our uptrend line. Put in a divergent high on EUR USD and breakdown back test. And here's a minor trend line here. I think if we can clearly get below these recent lows, it's going to open a door for more downside in Euro USD. And the daily chart of GLD. Those that don't trade futures, I like to watch the futures. You see more trades, but it's had this support zone here we've been bouncing on for a while, and today a breakdown. So unless this proves to be a whipsaw, again, we could see whipsaws in the market. We see a whipsaw in the stock market. Maybe we see a whipsaw in gold. But as of now, we have pretty much sell signals and breakdowns across the board. On both gold and the market, that is. And last but not least, one of the sectors that might give you some more bang for your buck if we get some more downside traction in the markets would be the semiconductors. SOXX is one of several semi ETFs. Put in recently a divergent high right here. That's negative divergence on the indicators, just like you had a divergent high right here before the drop into the March lows. Divergences, I always say, are not a sell signal or a buy signal. They're merely an indication of a trend reversal. Your sell signals come on a break of support, such as a well-defined uptrend line. So that's what we already had in stocks. And what we did is we fell to this 288, 88 support level. And we've been holding it like a champ. So the semis are still clinging to that right now. You can see that recent consolidation. A solid break, especially a solid daily close below there, should open the door for a move down to this next support level, about 270.68. What would that be? That would be roughly a drop of another 6 or so percent, which coincides with minimum downside in the stock market. One of the ETFs, or a couple of them you can use for SOX, are SOXS. That tracks the same Philex SOX Semiconductor Index, although it's 3 times leveraged. So you have to take that into account when trading it. Must have reverse splits. All my trend lines got moved. They don't make an auto adjustment on this charting platform. And the other ones you have are one-time non-leveraged ETFs, XSD, SMH, and you can see that they're telling a similar story. We had a divergent high here, but without a sell signal. We went in, put in another larger divergent high. We actually, looks like we broke down and back tested, and then the same story here. It's this recent level of consolidation. So that's it. We're going to wrap it up here. So unless the market can pull a rabbit out of its hat, especially on QQQ and snap back above those levels, looks like we're going lower. This would be your next target again on a break. That's the thing, the semis haven't yet moved below that recent consolidation range. So should we make a solid red close today, go much lower, we're down about 2% on SMH right now. So, look for about a 3% down. Or again, it's simple. Just look at the recent lows, and a solid break below there should open the door to that, at least that target there. If we get that, I'll follow up and try to let you know if I think there's going to be any more downside to come after that. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.